There's a hidden pattern in U.S. foreign policy that has drawn intense focus toward Venezuela, and it goes far beyond what most headlines tell you. On the surface, official statements often cite democracy, human rights, or stopping drug trafficking. But peel back the layers and you find a powerful strategic element at play. Oil, influence, global power dynamics, and control over energy resources. Venezuela sits on some of the largest proven oil reserves on Earth, more than 300 billion barrels, surpassing even Saudi Arabia. Yet this vast potential remains largely untapped and underutilized. Decades of economic mismanagement, corruption, political turmoil, and relentless international pressure have decimated a once thriving oil industry. Production that once exceeded 3 million barrels per day has collapsed to under 1 million barrels per day, representing barely 1% of global crude output, despite Venezuela holding roughly 17% of the world's proven reserves. For decades, Venezuela's economy was almost entirely dependent on petroleum exports. At its peak, oil accounted for over 90% of export revenues, powering government budgets, public services, foreign exchange reserves, and imports. But when global oil prices plunged in the mid-2010s, revenue dried up, the currency collapsed, and the economy spiraled downward. Between 2012 and 2021, the Venezuelan economy contracted sharply in one of the deepest peacetime recessions in modern history, underscoring how entrenched oil dependence made the nation vulnerable to external shocks and geopolitical pressure. U.S. sanctions targeting Venezuela's state-owned oil company, Petróleos de Venezuela S.A., or PDVSA, have played a central role in this transformation. Beginning in 2017, the United States progressively cut Venezuela off from financial markets and oil export channels, aiming to pressure President Nicolas Maduro's regime. Direct exports to the United States, which had once been a major customer, were halted, and secondary sanctions discouraged other nations and companies from buying Venezuelan crude. As a result, Venezuela's access to foreign currency collapsed and its oil infrastructure deteriorated even further due to lack of investment, maintenance, and technology. Between 2017 and 2024, estimates suggest Venezuela lost oil revenue equivalent to more than 200% of its GDP due to sanctions pressure, amounting to hundreds of billions of dollars in foregone income. This loss has had profound effects not only on government finances, but on everyday Venezuelans' ability to import food, medicine, and essential goods, intensifying shortages and contributing to sustained hyperinflation. The sanctions themselves were broad and multi-layered. They began with financial sanctions in 2017 that cut PDVSA off from U.S. financial markets, making it difficult to restructure debt or raise new funds. In 2019, oil sanctions banned U.S. entities from importing Venezuelan oil or exporting refined products to the country, instantly removing over 500,000 barrels per day from U.S. crude imports. Further sanctions extended to non-U.S. companies that continued to trade Venezuelan oil, including subsidiaries of foreign national oil companies, effectively shrinking global export avenues for Venezuelan crude. Despite these measures, Venezuela did not disappear from the oil map entirely. Alternative channels emerged as Caracas pivoted toward nations less concerned with U.S. pressure. China, once one of Venezuela's biggest buyers and creditors, began receiving crude as repayment for loans, while Iran supplied technical assistance and equipment to maintain oil operations. Russia, too, continued to engage with Venezuelan energy ventures, further complicating the geopolitical landscape. These partnerships helped stabilize production at levels above the maintenance crisis seen in the late 2010s, but output remains far below historical peaks. American policymakers frame Venezuela's oil not merely as an economic asset, but as a geopolitical leverage point, a resource that could shift balances of power in global energy markets. U.S. energy companies once held stakes in Venezuelan oil before nationalization policies transferred control to the state in the 1970s. Although compensation was offered, the narrative that American companies were displaced has influenced strategic thinking in Washington, where access to global oil resources is viewed as a matter of national security and influence. Donald Trump's public statements offer insight into this mindset. At various points, he explicitly tied Venezuela's oil to American strategic interests, calling the nationalization of assets historical theft, and vowing that the United States would reclaim influence if possible. In a dramatic escalation, U.S. forces captured and extradited President Maduro following a covert operation, creating an unprecedented flashpoint. Trump announced that the United States would temporarily oversee Venezuela and allow American energy firms to rebuild and control oil infrastructure, a language that signaled direct economic intention intertwined with geopolitics. Those moves were backed up by tangible pressure. The U.S. imposed heavy sanctions on oil entities and shipping, blockaded vessels, and seized tankers carrying Venezuelan crude. This blockade sharply curtailed exports, forcing PDVSA to halt or slow production at many sites due to storage limitations. With millions of barrels of residual fuel filling storage tanks and export avenues closing, Venezuela was forced into a crisis of operational management just to keep refineries from shutting down. The effects on the Venezuelan economy have been catastrophic. With revenue streams squeezed, the government resorted to printing more believers to meet obligations, accelerating currency depreciation and fueling inflation. At its peak in 2018, inflation exceeded 1 million% annually, decimating savings and purchasing power for ordinary citizens. While inflation has moderated from those extreme levels, it remains chronically unstable due to persistent revenue shortages. The humanitarian consequences have been immense. Venezuela's health system has deteriorated, electricity and water supply have become unreliable, and food shortages persist. As economic conditions worsened, millions of Venezuelans fled the country, creating one of the largest migration crises in Latin America, driven primarily by economic collapse linked to the contraction of oil revenue and loss of purchasing power for ordinary families. Beyond Venezuela's borders, the crisis has reverberated regionally. Cuba, heavily reliant on Venezuelan oil shipments for energy needs, has struggled with energy shortages and broader economic instability. Neighboring countries have faced increased migration flows, political tensions, and the challenge of hosting millions of refugees. U.S. military presence in the Caribbean expanded in response to tensions, drawing international concern and criticism for escalating geopolitical friction rather than alleviating humanitarian suffering. International reactions have been mixed. Some world leaders and organizations condemn unilateral sanctions and naval blockades as violations of international law and national sovereignty. Critics argue that using economic pressure to force political change undermines diplomatic mechanisms designed to maintain stability and respect territorial integrity. These criticisms highlight that economic coercion can exacerbate human suffering and regional instability, even when pursuing political goals. Despite these pressures, some analysts note that modest production gains can occur when sanctions are temporarily eased, as happened in 2023-2024, under negotiated political guarantees that briefly allowed licensed oil exports. But reviving Venezuela's oil industry to its former capacity would require massive investment, political certainty, and legal guarantees that currently do not exist. Estimates suggest it could take a decade and tens of billions of dollars to restore infrastructure and skilled labor required for sustained growth. Energy markets have responded in complex ways. While one might expect a significant supply shock from Venezuela's near collapse, global oil prices have remained relatively steady due to oversupply from other producers and strategic reserves from major economies. Venezuela today contributes a small percentage of global oil supply, meaning its absence has not caused a major price spike, though its potential resurgence continues to attract strategic interest. So, was Trump's focus on Venezuela really about oil? The answer is multifaceted. Official rhetoric emphasized democracy, human rights, and counter-narcotics objectives. But strategic analysis shows energy resources have been a central factor, intertwined with policy decisions, sanctions, economic pressure, and global power competition. Venezuela's oil, despite being underutilized, remains a major thread in understanding how energy, economics, and geopolitics intersect. In the end, Venezuela is not merely a case study of one leader's foreign policy obsession. It is a snapshot of how energy, economics, and global power dynamics intersect on the world stage. Whether driven by ideology, economic interests, or a complex blend of both the strategic importance of Venezuelan oil and the United States' desire to shape its future, is one of the most defining elements of modern geopolitical strategy. If this changes how you view U.S. foreign policy and Venezuela's place in world geopolitics, subscribe for deeper analysis of the forces shaping global events.